Before we dive in, a quick and important note. I am not a financial advisor, and this presentation is for educational and entertainment purposes only. The information shared here does not constitute financial, legal, or tax advice. Investing involves significant risk, including the potential loss of principal. You should always conduct your own thorough research and consult with a licensed professional before making any financial decisions. Alright, let's get into it. The first time I downloaded a stock market app, it felt like I'd been handed a key to a secret club. The world of Wall Street, right there in the palm of my hand, felt like a video game. Green candles meant I was winning, red candles meant I was losing. Simple. I saw a stock everyone was screaming about online, a so-called meme stock that was going to the moon. FOMO, the fear of missing out, hit me like a ton of bricks. So I did what millions of others did. I threw $1,000 at it. I checked my phone every 30 seconds, watching the number go up. I was a genius. Then just as quickly I watched it go down, and down, and down. In less than 48 hours, my $1,000 investment was worth about $300. That's when it hit me. These apps aren't video games. They're not toys. They are incredibly powerful tools. And a tool can either build a house or tear one down, depending entirely on the person holding it. The trading app on your phone right now is either the single most powerful wealth-building machine you will ever own, or it is a digital casino, meticulously engineered to exploit your human psychology and slowly drain your bank account. There is no middle ground. And my promise to you today is that by the end of this, you will know exactly how to make sure it's the former, not the latter. We are going to transform that app from a source of anxiety and potential loss into your single greatest asset for building real, long-term financial freedom. We're going to cover it all. We'll start with the absolute basics. Making your account an impenetrable digital fortress so no one can ever touch your money. Then we'll expose the hidden psychological traps, the confetti, the social pressure, the carefully chosen colors that these apps use to trick you into making emotional, impulsive decisions. We'll break down the fundamental difference between gambling and actual investing, and I'll show you how to use the app's own tools to do real research, not just follow the hype. You will learn the critical order types that protect you from paying too much for a stock, and the ones that protect your profits automatically. Most importantly, you will learn the 3 catastrophic mistakes that wipe out over 90% of new investors, and how to avoid them with disciplined, simple strategies. This isn't about get-rich-quick schemes. This is about getting wealthy safely and effectively, using the very technology that's designed to work against you if you don't know the rules of the game. So let's start with the absolute foundation. Before you ever buy a single share of anything, before you even deposit your first dollar, you have to build the walls of your castle. We have to talk about security. Sounds boring, I know. It's not as exciting as picking a 10-bagger stock. But I want you to think about it like this. What's the point of building a fortune if you leave the front door of your vault wide open? Your brokerage account isn't like your social media account. If someone hacks it, they aren't just stealing your vacation photos, they're stealing your future. They're stealing your hard-earned money. So we take this part deadly seriously. The first, non-negotiable step is enabling two-factor authentication, or 2FA. Every single reputable stock app offers this. And if yours doesn't, you need to delete it immediately and find a new one. Period. Think of 2FA like this. Your password is the first key to your vault. But 2FA adds a second separate lock that requires a second separate key. That second key is a unique, time-sensitive code that gets sent directly to your phone or an authenticator app. So even if a hacker in another country manages to steal your password, maybe from a data breach at another company where you foolishly reuse the same password, they still can't get in. When they try to log in, the app will ask for that 6-digit code. And since they don't have your physical phone, they're stopped dead in their tracks. They have the key, but they can't get past the second lock. Setting it up takes less than 2 minutes. Go into your app security settings right now. Pause this video if you have to, and turn on two-factor authentication. It is the single most effective thing you can do to protect your money. Next, let's talk about that first key, your password. We all know we're supposed to use strong, unique passwords, but let's be honest, most people don't. We use our dog's name and the year we were born. For your financial accounts, that is unforgivable. Your brokerage app password should look like a cat walked across your keyboard. It needs to be long, at least 16 characters, and it needs to be a random mix of uppercase letters, lowercase letters, numbers, and symbols. And most importantly, it must be a password you have never used anywhere else. Ever. Why? Because massive data breaches happen every single day. If you use the same password for your brokerage account that you used for that pizza delivery app you signed up for 5 years ago, you're just waiting for disaster. When that pizza app gets hacked, criminals take that list of emails and passwords and use automated programs to try them on every banking and investment app in existence. They know people are lazy. Don't be one of them. The best way to handle this is to use a password manager. Tools like LastPass, 1Password, or Bitwarden will generate and securely store these insane, unhackable passwords for you. You only have to remember one master password, and it does the rest. It's a simple habit that provides an immense layer of protection. Finally, we need to immunize you against the most common type of attack, phishing. This is where hackers try to trick you into giving them your information. You'll get an email or a text message that looks like it's from your brokerage. It will look official. It will have the company's logo, and it will have an urgent, scary message like, "Suspicious activity detected on your account. Click here to verify your identity," or "Your account has been suspended. Log in immediately to restore access." Their goal is to make you panic. They want you to click that link without thinking. But that link doesn't go to the real website. It goes to a perfect replica they built to steal your login information. The second you type in your username and password, they have it. And if you don't have 2FA enabled, your money is gone in seconds. Here's how you never ever fall for this. First, never click on a link in an urgent security email. Ever. Instead, if you're worried, close the email, open a new browser window, and manually type in the official website address yourself, or just open the app on your phone. If there's a real issue, there will be a notification waiting for you there. Second, look at the sender's email address. Hackers are clever, but they can't perfectly fake it. It might say Robinhood Security, but the address will be something weird, like secure-update123@netmail.ru. That's a massive red flag. Legitimate companies will always email you from their official domain. Third, look for bad grammar or spelling mistakes. Large financial institutions have teams of people who check these emails. A scam email often has awkward phrasing or simple errors. Be skeptical. Treat every single communication from your brokerage with a healthy dose of paranoia. Now, locking down your account with 2FA, a strong password, and a defense against phishing is the essential first step. That protects you from outside threats. But what's truly terrifying is that the biggest threat isn't someone from the outside trying to get in. The real danger is how the app itself is designed to hack into your brain and make you your own worst enemy. Securing your password is the easy part. The hard part is securing your mind from the platform itself. And that's where the real battle for your wealth is won or lost. So let's talk about how they do it. How they turn your own brain against you. It starts with something you've probably heard of, but maybe not in this context: dopamine. Every time you open that app and see a flash of green, your brain releases a tiny hit of this feel-good chemical. It's the same chemical that's triggered by eating a piece of chocolate, getting a like on social media, or winning a hand of poker. Feels good. Feels like a reward. And your brain, in its ancient primal wiring, wants more of it. So you check again. And again. You start associating the app with that feeling of potential reward. Conversely, when you see red, your brain gets a shot of cortisol, the stress hormone. This creates a sense of panic, of urgency. The fear of loss is a motivator that's twice as powerful as the pleasure of a gain. So what do? You might panic sell to stop the pain. Or you might double down, buying more of a losing stock in a desperate attempt to turn that painful red into a pleasurable green. Either way, you're reacting emotionally. You're not investing, you're gambling. And the app is your slot machine. The constant flashing up and down numbers are designed to keep you pulling that lever, chasing the dopamine and running from the cortisol. This isn't an accident. It's a meticulously engineered process called gamification. The app developers have borrowed every trick in the book from the worlds of video games and social media to keep you hooked. Think about it. When you sign up, what do they often give you? A free stock. This isn't just a marketing gimmick. In video game design, it's called a tutorial reward. It gives you an immediate, effortless win. Your brain gets a dopamine hit right out of the gate, wiring you to associate the app with positive feelings before you've even risked a single dollar of your own money. Then comes the interface. The satisfying swoosh sound when you execute a trade. The digital confetti that explodes on your screen when you buy a popular stock. The lists of top movers or trending stocks, which create a powerful sense of FOMO, fear of missing out. It feels less like you're allocating capital in the global economy, and more like you're trying to catch a rare Pokemon before it gets away. They're turning a serious long-term process into a fast-paced, addictive game. But in this game, when you lose, you don't just lose points. You lose real money. Your money. This gamification feeds into a deeper, more dangerous psychological trap: the illusion of control. When you open your app, you're presented with a dashboard. You've got real-time stock tickers, customizable watch lists, and sophisticated-looking charts with lines and indicators that you can draw all over. It makes you feel powerful. It makes you feel like a Wall Street professional sitting at a Bloomberg terminal. You have all this data at your fingertips, so you must be able to predict what's going to happen next, right? Wrong. This fire hose of information is deliberately overwhelming. It's designed to make you feel like you need to do something with it. All those flashing green and red numbers, the breaking news alerts, the second-by-second price updates, they create a false sense of urgency. They encourage you to trade, to react to the noise. But successful investing isn't about reacting to the noise. It's about having a plan and sticking to it, ignoring the daily chaos. The app, by its very design, makes that nearly impossible. It preys on your instinct to act, turning you from a patient, long-term investor into a frantic day trader, constantly buying and selling based on meaningless short-term fluctuations. And that, right there, is the secret to how they really make their money. You've probably heard these apps advertise commission-free trading. And you've probably thought, great, it's free. But you have to ask yourself a question. How does a company that lets you trade for free become a multi-billion-dollar corporation? The answer is a classic business saying, if you're not paying for the product, you are the product. Most of these platforms make a huge portion of their revenue from something called payment for order flow, or PFOF. Now that sounds complicated, but the concept is shockingly simple. When you hit the buy button on a stock, your order doesn't go straight to the New York Stock Exchange. Instead, the app bundles your order up with thousands of others and sells that bundle to a massive high-frequency trading firm, also known as a market maker. These giant firms pay your brokerage app for the right to execute your trades. Why would they pay for that? Because it gives them a massive information advantage. They get to see millions of buy and sell orders from retail investors like you just milliseconds before they're executed. In that tiny fraction of a second, their supercomputers can jump in front of your trade. For example, if you place an order to buy a share of Apple for $170, they can see that order coming, buy the share for $169.99, and then sell it to you for your price of $170. They just made 1 cent. Now 1 cent doesn't sound like a lot, but when you multiply it by billions of trades every single day, it becomes an astronomical amount of money. They are skimming fractions of a penny off of every single one of your trades. It's basically a tax on your activity, and it's completely invisible to you. So now do you see why the app is designed to be a game? Why it's built to be addictive and to encourage you to trade as often as possible? It's not because they want you to become a better investor. It's because every single time you press that buy or sell button, they get paid. Your overtrading, your emotional decisions, your FOMO-driven clicks, that is their business model. The more you trade, the richer they get. Their financial success is directly linked to your bad habits. They have a vested interest in you being an impulsive, emotional, and overactive trader. That's a terrifying conflict of interest. The entire system is engineered to extract value from your activity. And the first step to protecting yourself is to understand that you are not playing a game. You are walking onto a battlefield that has been designed to make you fail. But knowing this is your first piece of armor. Awareness is your shield. So what do? How do we use these powerful tools without letting them use us? We start by building a mental firewall, and you can start doing that right now. First, go into your phone's settings and turn off every single notification from your trading app. Every single one. No price alerts, no breaking news. No, you might be interested in this stock messages. You will decide when you look at your portfolio, not the other way around. Reclaim your attention. Second, schedule your check-ins. Don't open the app impulsively whenever you have a spare minute. Decide that you will only look at your investments once a day, or even once a week at a specific time. Put it in your calendar. This transforms it from a reactive habit into a deliberate, planned action. You are taking back control. Third, make a rule to never ever make a trade based on an emotion. If you feel a surge of excitement because a stock is rocketing up, or a pit of fear because it's crashing down, that is the worst possible time to act. Close the app. Walk away. The decision will still be there tomorrow, but the emotional charge won't be. Your best financial decisions will always be the most boring ones. These are just the first foundational steps. They are about creating space. Space between you and the app. Space between a market event and your reaction. Space for your rational brain to take back control from your emotional, impulsive brain. Because once you've built this firewall and secured your mind from their psychological manipulation, you can finally start to use these apps for what they should be: simple, boring tools for executing a well-thought-out long-term financial plan. Now that you understand the battlefield and have your first line of defense, it's time to go on the offensive. It's time to build a system, a personal investing protocol, that makes you completely immune to these tricks. A system that doesn't rely on willpower, but is instead built on rules that force you to make smart, disciplined decisions, no matter what the market or the app is trying to make you feel. I call this protocol the Fortress Method, because that's what we're doing. We're not just downloading an app. We are building a psychological fortress around our money, with us on the inside and all the noise, the hype, and the emotional manipulation locked outside. Willpower fails. A fortress built correctly does not. The first layer of this fortress has nothing to do with picking stocks. It has everything to do with sanitizing your environment. We're going to perform a digital cleanse on your trading app itself. Think of a fighter pilot. Before they ever engage in a dogfight, they have a pre-flight checklist. They ensure every switch is in the right place, every gauge is calibrated, and the cockpit is sterile and functional. Their life depends on it. Your financial life depends on this too. So step 1, sanitize the cockpit. First, and this is non-negotiable, you are going to turn off every single notification from your stock market app. All of them. Price movement alerts, news alerts. You might be interested in this stock alerts. Kill them all. This isn't about avoiding a minor annoyance. This is about severing a connection that is scientifically designed to make you a worse investor. Every time your phone buzzes with a stock alert, it's a tiny pull on a slot machine lever. Your brain gets a jolt. A stock you own is up 3%? Dopamine hit. A stock on your watch list is down 5%? Cortisol spike. You are conditioning your brain to react, instantly and emotionally, to meaningless short-term noise. You're training yourself to be a day trader, even if you want to be a long-term investor. The app developers know this. They know that a notification saying XYZ stock is up 10% today is far more likely to trigger a FOMO-driven, impulsive buy than it is to trigger a calm, rational analysis of the company's 10-year plan. By turning off notifications, you reclaim control. You decide when you look at the market. The market doesn't get to decide for you. You move from being reactive to being proactive. This single act is the most powerful thing you can do to protect yourself. Second, you are going to radically simplify your watch list. I've seen people with watch lists 100 stocks long. It's a chaotic collection of meme stocks, companies they heard about on the news, and random tickers they added on a whim. This is not a watch list. It's a list of distractions. It's a menu for financial gambling. From now on, your watch list is a sacred space. It is reserved only for companies you have seriously researched and would be comfortable owning a piece of. Your new rule is this: your watch list can have a maximum of 10 to 15 companies on it. That's it. This forces discipline. It means you can't just add stocks casually. It makes you ask, is this company good enough to displace one of the others on my highly curated list? This transforms your app from a source of endless, distracting, shiny objects into a focused dashboard of your highest conviction ideas. A professional investor doesn't track 100 random things. They deeply understand a few great things. This is how you start acting like one. Third, declutter your app's home screen. Most of these apps are designed to look like the dashboard of a spaceship. Flashing colors, scrolling tickers, lists of top movers and trending stocks. This is pure casino design. It creates a sense of constant, urgent action. It makes you feel like if you're not doing something right now, you're missing out. You need to turn all of that off. Go into the settings and customize your interface. Get rid of the news feeds. Get rid of the daily movers list. Get rid of everything except the two things that matter: the total value of your portfolio and your small curated watch list. You want the app to be as boring as possible. You want to open it, see your core information, and have no other buttons or colors luring you into making a snap decision. A boring interface leads to boring, consistent, and profitable investing habits. An exciting interface leads to gambling. We are building a fortress, not an arcade. Okay, the cockpit is sanitized. The environment is under control. Now for the second and arguably most important layer of the fortress, the research protocol. I call this the 5-point gauntlet. Before a stock is even allowed onto your pristine 10-stock watch list, It must pass through this gauntlet. This is a simple 5-question checklist you must answer in writing. Not in your head, you need to write it down, even if it's just in a notes app on your phone. This act of writing forces clarity. Question 1. In one simple sentence, what does this company actually do to make money? Not what its stock price is doing, not what analysts are saying about it. What does the business do? If you can't explain it in a way a 10-year-old would understand, you have no business investing in it. NVIDIA makes specialized computer chips that power artificial intelligence. Costco sells bulk goods to members for a low margin and makes most of its profit from annual membership fees. Coca-Cola sells branded sugar water all over the world. If your answer is full of jargon and buzzwords, it's a red flag that you don't truly understand the business. This is your first line of defense against hype. Question 2. Who are its top 2 or 3 competitors, and what makes this company better or different? This forces you to think about the competitive landscape. No company operates in a vacuum. Is this company the low-cost leader? Do they have the best brand? The best technology? Thinking about competition immediately grounds you in business reality. Loving Apple's iPhone isn't enough. You have to understand how it competes with Samsung and Google. Believing in Tesla isn't enough. You have to understand how it's positioned against Ford, GM, and a dozen other EV makers. This question prevents you from falling in love with a story without understanding the war it has to fight every single day. Question 3. What is one major, legitimate risk or headwind this company faces in the next 5 years? This is the most crucial question for fighting confirmation bias. When we get excited about a stock, our brain only wants to see the good news. We actively ignore the bad. This question requires you to play devil's advocate against your own idea. For an electric vehicle company, it could be rising competition or battery supply chain issues. For a social media company, it could be government regulation or changing user tastes. Every single company has risks. A mature investor doesn't ignore them. They identify them, understand them, and decide if the potential reward is worth taking them on. If you can't think of a single serious risk, you haven't done enough research. Question 4. Look at a chart of the company's revenue and profit over the last 5 years. Is it generally going up, down, or is it flat and erratic? You don't need to be a financial analyst for this. Just look at the big picture. Is this a growing, healthy business? Or is it a struggling or unpredictable one? This is a simple reality check. A stock price can fly all over the place based on hype, but the underlying revenue and profit tell a much truer story about the health of the actual business. You want to invest in businesses that are getting stronger, not just stocks that are getting more popular. And finally, question 5. Write down one clear, specific reason why you believe this company will be a larger, more profitable business in 10 years than it is today. This is your long-term thesis. It's the anchor that will hold you steady when the market gets stormy. Your reason can't be because the stock will go up or because AI is the future. It has to be specific to the company. I believe Apple will be bigger in 10 years because its ecosystem of products is so sticky that customers will continue to pay a premium for new devices and services. I believe Costco will be bigger because its business model of low prices and membership fees builds incredible customer loyalty that is difficult for competitors to break. This written thesis is your North Star. When the stock drops 20% and the news is screaming sell, you don't panic. You pull out your thesis and ask one simple question. Has this reason changed? If the answer is no, then the price drop is a buying opportunity. If the answer is yes, then you have a legitimate reason to reconsider your investment. This 2-part system, sanitizing the cockpit and running every potential investment through the 5-point gauntlet, is the foundation of the Fortress method. It's all preparation. It's the boring work you do when the market is closed, when your emotions are calm. It ensures that by the time you actually open your app to make a trade, the decision has already been made, rationally and logically. The app is reduced to what it should be. A simple tool for execution, not a machine for emotional manipulation. You've now built the walls and the gatehouse of your fortress. You've created a calm environment and a rigorous process for letting any new ideas inside. But now comes the most dangerous moment of all. You've done the work, you've found a great company at what seems like a fair price. It's time to actually click that big green buy button. And that single action is a psychological minefield all on its own. Because every fiber of your being is screaming 2 contradictory things at once. First, there's the voice of fear. The voice that says, what if you're wrong? What if the second your money goes in, the stock plummets? All that research, all that time wasted. You'll feel like a fool. This is the fear of immediate loss, the sting of being proven wrong right out of the gate. It causes a kind of paralysis where you just watch the price, waiting for the perfect moment that never ever comes. But then there's the other voice, just as loud, just as powerful. The voice of greed, a FOMO, the fear of missing out. This voice screams, what if you don't buy? What if this is the bottom and tomorrow it shoots up 20% without you? You did the work, you know it's a good deal. Every second you wait is money you're leaving on the table. This voice pushes you to act impulsively, to throw caution to the wind and just get in, no matter the price. This internal war between fear and greed is what makes that buy button so terrifying. It feels like you're standing on a cliff edge, and you have to choose between the fear of falling and the fear of being left behind. But what if I told you there's a third option? What if you could take emotion almost completely out of the equation? What if you could use the app itself not as a casino button, but as a set of precision tools designed to execute a logical plan? This is where we separate the amateurs from the pros. Amateurs see a buy button. Pros see a control panel with different types of orders. And understanding these orders is the single most important mechanical skill you will ever learn as an investor. It's the difference between gambling and executing a strategy. Let's start with the one most people use and the most dangerous, the market order. A market order is simple. It tells your broker, I want to buy this stock right now, and I will pay whatever the going price is. Prioritizes speed over everything else. You click the button and within a second you own the shares. Sounds great, right? It's fast. It's easy. It's also like walking onto a used car lot and shouting, I want that car, and I'll pay whatever price you're asking. You give up all your negotiating power. The price you see on the screen when you hit buy is not always the price you get. That's called slippage. In the split second it takes for your order to go through, the price can change. For a huge stable company like Coca-Cola during the middle of a trading day, that slippage might be a penny. No big deal. But what if you're buying a more volatile stock? Or what if you're trying to buy right when the market opens, when prices are flying all over the place? That slippage could be dollars per share. I've seen people place a market order for a hot tech stock at 9:30 a.m., thinking they were getting it for $100, only to have their order filled at $105. They instantly lost 5% because they prioritized speed over price. A market order is a tool of impatience, and impatience is expensive. So what's the alternative? The tool of the professional, the limit order. A limit order says something completely different to your broker. It says, I want to buy this stock, but only if I can get it for a specific price or better. You set the limit. You are in control. Let's say a stock is trading at $52. You've done your research and decided you only want to buy it if you can get it for $50 or less. You place a limit buy order for $50. Now, one of two things will happen. If the stock price dips down to $50, your order will automatically execute, and you'll buy the shares at your price. But if the stock price never comes down to 50 and instead shoots up to 60, your order never fills. You don't get the stock. And this is a crucial concept. The risk of a limit order is that you might miss out if the price runs away from you. But the benefit is monumental. You never ever overpay. You stick to your plan. You force the market to come to you on your terms. A limit order is the ultimate defense against FOMO and impulse. It's your financial discipline automated. The same works for selling. A limit sell order says, I want to sell my stock, but only if I can get a certain price or more. It ensures you lock in the profit you want, instead of just dumping your shares at whatever the current price is. Now let's get into safety, because protecting your money is even more important than making it. This brings us to the most critical order type for risk management, the stop-loss order. A stop-loss is your pre-planned emergency exit. It's an order you set that says, if this stock falls to a certain price, sell it immediately. Get me out. Let's imagine you bought that stock at $50. You decide beforehand, the most I am willing to lose on this investment is 10%. So you place a stop-loss order at $45. Now you can sleep at night. If the stock does well, great. But if the company releases terrible news and the stock starts to tank, the moment it hits $45, your stop-loss order triggers and automatically sells your shares. Yes, you took a 10% loss, but you prevented a 20, 30, or 50% loss. You defined your maximum pain point ahead of time, when you were calm and rational, instead of trying to make a decision in the middle of a panic watching your money evaporate. A stop-loss order is the seatbelt for your portfolio. You hope you never have to use it, but you would be an absolute fool to invest without it. Now there's a small catch. A standard stop-loss order when triggered becomes a market order. So, in a very fast, crashing market, if the price plummets past your $45 stop price, you could experience slippage and get sold at, say, $44.50. To combat this, there's a more advanced version called a stop limit order. This combines the two ideas. It says, if the stock falls to my stop price of $45, don't just sell at any price. Instead, activate a limit order to sell, but only if I can get $44.75 or better. You set two prices, the stop price that acts as the trigger, and the limit price that acts as your absolute lowest acceptable selling price. This protects you from massive slippage in a flash crash. The trade-off? If the stock price gaps down instantly from 46 straight to 44, your order might not fill because it never traded at your limit price. You have more price protection but less certainty of getting out. So, let's put this all together into a professional workflow. An amateur sees a stock they like at $52. They get excited, hit market buy, and hope for the best. A pro does their research and says, I like this company, but my valuation shows it's a good buy at $50. Step 1. They place a limit buy order at $50. They don't chase the price. They wait. Let's say a week later the market dips and their order fills. They now own the stock at their target price. Step 2. Immediately they define their risk. They decide they're willing to lose 10%. They place a stop-loss order at $45. Their downside is now protected automatically. Step 3. They define their goal. They think the stock is worth $70. They can place a limit sell order at $70. This is often called a take-profit order. Look at what just happened. The pro has created a fully automated trade, with a defined entry point, a defined exit point for a loss, and a defined exit point for a profit. The entire strategy is baked into the orders themselves. Emotion has been almost entirely removed. It's no longer about gut feelings or panic. It's about execution. You've used the tools in the app to build a fortress around your decision-making, protecting you from your own worst enemies, fear and greed. You've executed your plan with the precision of a surgeon. The trade is made. The stock is in your account. But now the real game begins. The daily, hourly, even minute-by-minute temptation to check your phone, to react to every little blip on the screen. And conquering that impulse is the key to turning a single good trade into long-term wealth. This little device in your pocket, the one you use to order pizza and text your friends, has now become a direct pipeline to the most powerful and most volatile wealth creation machine in human history. And it's been designed from the ground up to feel like a game, a casino. Every time you open that app, you're pulling the lever on a slot machine. The bright green and red colors, the satisfying little chime when a trade executes, the instant gratification of seeing your balance tick up by $10. It's all engineered to give your brain a tiny squirt of dopamine. That's the same chemical that makes you feel good when you eat a piece of chocolate or get a like on social media. It's a reward chemical. And your brain, being the efficient machine that it is, learns very quickly. Open app, get reward. Open app, get reward. This creates a powerful feedback loop. The market goes up, you check your phone. Dopamine hit. The market goes down, you check your phone, panicking. Adrenaline and cortisol hit. A stock you own is in the news, you check your phone. Curiosity and dopamine. It's a constant cycle of chemical reactions that has almost nothing to do with sound investing. It's pure, uncut emotional reactivity. And it is the single biggest destroyer of wealth for new investors. Let me paint you a picture. Meet two investors. Let's call them Reactive Ryan and Strategic Sarah. Both just downloaded their first trading app. Both bought 100 shares of the same solid, well-known tech company. Let's call it Innovate Corporation. They buy it at $100 a share. A $10,000 investment. Ryan wakes up the next morning. The first thing he does before even getting out of bed is grab his phone and open the app. Innovate Corp is down 2%. It's at $98. His $10,000 is now $9,800. Up. A knot forms in his stomach. He reads a headline that says tech stocks dip on inflation fears. Fear. He immediately starts thinking, maybe I should sell before it goes lower. I can always buy back in when things look better. He resists the urge, but the damage is done. His day is now framed by that $200 paper loss. He checks his phone again at his coffee break. It's now down 3%. The knot in his stomach tightens. He checks again at lunch. It's recovered a bit, now only down 1.5%. A small sigh of relief. He checks 5 more times in the afternoon. The little green and red numbers are a yo-yo, playing with his emotions. By the end of the day, the stock closes down 4% at $96. His investment is now worth $9,600. He's lost $400 in a single day. The fear is overwhelming. He thinks, this was a mistake. I need to get out. He sells all his shares at $96, locking in his $400 loss. He tells himself he'll wait for a better time to invest. Now let's look at strategic Sarah. She also bought Innovate Corp at $100. She believes in the company for the long term. She understands that market fluctuations are normal. She wakes up, has her coffee, goes to work. She doesn't open her app. Why? Because her strategy doesn't depend on what the stock does today or tomorrow. Her plan is to hold Innovate Corp for at least 5 years unless the fundamental reason she bought it changed dramatically. A single day of market noise isn't a fundamental change. At the end of the week, she opens her app for her scheduled weekly check-in. She sees that Innovate Corp is now trading at $97. She's down $300. Her reaction? Nothing. It's just data. It doesn't affect her. In fact, her plan also included a rule. If a great company she owns drops more than 10% for no good reason, she'll consider buying more. The current price is irrelevant to her long-term plan. 2 weeks later, Innovate Corp announces a new product. The stock jumps 15% in a day. It's now trading at $112. Sarah, during her next weekly check-in, sees her position is now worth $11,200. She's up $1,200. Her reaction? Again, nothing. She closes the app and goes on with her life. Meanwhile, where is reactive Ryan? He saw the news. He saw the stock he just sold for $96 skyrocket. Now a new emotion takes over: FOMO, fear of missing out. He's kicking himself. I knew it was a good company. I should have held on. He sees the price climbing and thinks, I have to get back in before it goes to the moon. So he buys back in. But he doesn't get it at $112. By the time his order fills, it's $114. He just locked in a $400 loss, and then bought the exact same stock back at a $14 per share higher price. He has fewer shares and a much worse cost basis. All because he couldn't stop looking at his phone. Ryan is playing the app. Sarah is playing the market. And those are two very, very different games. The app wants you to be Ryan. Your long-term wealth depends on you being Sarah. So how do you do it? How do you break the cycle and become a strategic Sarah? It comes down to creating friction. You need to make it harder for your impulsive brain to take over. First, and this is the most important piece of advice in this entire section, turn off the notifications. Right now, pause this video if you have to. Go into your phone settings, find your trading app, and disable every single notification. No price alerts. No breaking news. No, you might be interested in this stock pop-ups. Nothing. You are severing the direct line that the app uses to jolt your nervous system. The app should only give you information when you decide you want it, not when it decides to push it to you. This single act reclaims an enormous amount of mental power. Second, schedule your check-ins. You don't need to look at your portfolio every day. For a long-term investor, you barely need to look at it every month. But let's be realistic. At the beginning, that's tough. So start with a rule. You are only allowed to open the app once per day, after the market closes. That's it. No peeking at lunch. No quick looks in the bathroom. Once a day. This transforms the activity from a reactive, emotional twitch into a deliberate, scheduled task. It removes the panic of watching the numbers change in real time. Third, never ever make a buy or sell decision while you are looking at the app for the first time that day. Your rule should be, I can look but I can't touch. If you see something that makes you want to act, a big gain, a big loss, your job is to close the app. Walk away. Think about it. Does this new information actually change your long-term thesis for owning this asset? 99% of the time, the answer is no. A stock being up or down 5% on the day is just noise. It's not new information about the business itself. By enforcing a cooling-off period, even just a few hours, you allow the rational part of your brain to catch up with the emotional part. And finally, have a plan before you open the app. This is what separates investors from gamblers. A gambler walks into a casino and just sees what happens. An investor has a strategy. Your strategy could be as simple as, I am putting $500 into my index fund every month no matter what the price is. My only job today is to execute that plan. Or it could be, I have a watch list of 5 companies. I will only buy one of them if it drops below a specific price I've already determined through my research. When you have a pre-written plan, the app becomes a simple tool for execution, not a source of temptation. You open it, you do the one thing you plan to do, and you close it. By turning off notifications, scheduling check-ins, creating a cooling-off period, and having a plan, you are fundamentally changing your relationship with the app. You're taking it from being the slot machine in your pocket and turning it back into what it's supposed to be: a boring, simple calculator for managing your investments. You are building the discipline that separates a panicked gambler from a patient wealth builder. You've built the fortress walls around your mind, protecting you from the emotional roller coaster of daily price swings. You've silenced the siren song of the dopamine hits. But now, when you do your scheduled check-in, when you calmly and deliberately open that app, what are you actually supposed to be looking at? Because beyond the big green and red number at the top of the screen lies a labyrinth of data, charts, and metrics designed to look important. PE ratios, market caps, volume, bid-ask spreads. It's a language all its own. And misinterpreting that language is just as dangerous as trading on emotion. In our next part, we're going to arm you with the translator. We're going to show you which numbers matter, which ones are just noise, and how to read the story your portfolio is actually trying to tell you. Your app is screaming at you. It's a wall of numbers, a chaotic symphony of red and green arrows, percentages, and dollar signs all fighting for your attention. And every single one of them is designed to trigger a reaction. A jolt of fear when a number is red. A rush of euphoria when it's green. But this isn't communication. It's just noise. And reacting to noise is how you lose the game. Our mission right now is to hand you the secret decoder ring. The universal translator that lets you hear the one quiet, calm voice that actually matters. The voice of your own portfolio. Let's start by separating the signal from the noise. Imagine you walk into a hospital emergency room. You hear beeping machines, people shouting, phones ringing, that's the noise. But the doctor walks past all of that and goes straight to the patient to check their vital signs. Heart rate, blood pressure, temperature. Those are the signals. They tell the real story of the patient's health. Your investment app is that noisy emergency room. We need to teach you how to be the doctor, not the panic bystander. We need to find the vital signs. The first and most important vital sign is your total return. Not the big, flashy number at the top of the screen that says you're up or down for the day. That number is pure, uncut, 100 proof noise. It's the loudest, most obnoxious patient in the emergency room. Why? Because it has no context. It tells you what happened in the last few hours, which, in the grand scheme of your financial life, is as insignificant as a single heartbeat in an entire day. Let me tell you about a guy named Mark. Mark bought $1,000 worth of an S&P 500 index fund. For 6 months it did great. He was up 10%, $100. He felt like a genius. Then one Tuesday the market had a bad day. He opened his app and saw a big scary number. Minus $200. Red. Alarming. His heart pounded. He thought, I've lost $200. He panicked and sold everything to cut his losses. But what did he miss? He was so focused on the noise of that one day's drop that he ignored the signal. The signal was his total return. Even after that bad day, his initial $1,000 investment was still worth $1,100. He was still up $100 overall. He sold a winning position because he listened to the short-term scream instead of the long-term whisper. Don't be Mark. Always look at your total return on any investment. That's the real score. That's signal number 1. The second vital sign is your portfolio allocation. This is usually shown as a pie chart. Most people glance at it and think, oh, that's pretty, and move on. They are making a massive mistake. This isn't just a colorful graphic. It's an X-ray of your portfolio's skeleton. It shows you how much risk you're truly taking. If that pie chart is just one big slice, say 95% in one single tech stock, you don't have a portfolio. You have a lottery ticket. You've basically bet your entire financial health on one patient surviving. If that patient gets sick, you're wiped out. A healthy allocation, a strong skeleton, means you're diversified. You have slices in technology and healthcare, in consumer goods, in industrial companies. Now, if the tech sector has a terrible month, it's like one of your patients has a broken arm. It's not great, but your other patients, your other investments are healthy. They can support the portfolio while the other one heals. Your app's pie chart isn't decoration. It's your single best defense against catastrophe. It's the signal that tells you whether you're standing on solid ground, or on a tightrope in a hurricane. Look at it once a month. If any one slice gets terrifyingly large, it might be time to rebalance to spread that risk to reinforce your foundation. The third vital sign is one most people never even look for. It's called your cost basis. This sounds complicated, but it's incredibly simple and powerful. Your cost basis is the total amount of money you have actually paid for an investment, including fees. It's your portfolio's memory. Why is this so critical? Because it's the ultimate source of truth. The current market price of a stock is just an opinion. It's what someone is willing to pay for it right now. Your cost basis is a fact. It's what you paid for it. The difference between the market price and your cost basis tells you your actual, unrealized profit or loss. It cuts through all the noise of daily price swings. Let's say you bought a share of a company for $100. That's your cost basis. The next day, it shoots to $150. Amazing. The day after, it drops to $120. The app screams at you that you're down $30 for the day. Panic sets in. But then you consult the vital sign. You look at your cost basis of $100. The truth is, you are still up $20 on your investment. The daily drop was noise. The cost basis provided the signal. It's your anchor in the storm, constantly reminding you of your true position. Now that we know the vital signs for the whole portfolio, let's zoom in on the individual stocks themselves. When you click on a specific company, you're hit with another tidal wave of data. But again, only 2 of these numbers really matter for a beginner trying to understand the health of their investment. Think of these as the individual patient's blood pressure and temperature. First is the PE ratio. That stands for price to earnings ratio. This is the single most important number for understanding if a stock is cheap or expensive. It's the company's price tag. The PE ratio tells you how many dollars you have to pay to get $1 of the company's annual profit. So, a PE of 10 means you're paying $10 for every $1 of earnings. PE of 100 means you're paying $100 for that same dollar of earnings. Is a high PE bad and a low PE good? Not at all. It just tells you what kind of company you're buying. A company with a high PE, like many tech startups, is like a designer handbag. You're paying a huge premium because you expect it to become even more valuable and popular in the future. You're paying for growth. A company with a low PE, like a big old railroad or a utility company, is like a sturdy, reliable pair of work boots. It's not flashy, but it's solid. It makes predictable money, and you're getting it at a reasonable price. You're paying for value. The PE ratio is the signal that tells you whether you're buying a racehorse or a workhorse. Both can be great investments, but you need to know which one you're betting on. The second individual stock vital sign is the dividend yield. If the PE ratio is the price tag, the dividend yield is the reward for being a patient owner. A dividend is when a company takes some of its profits and gives it directly back to you, the shareholder, as cash. The yield is just that cash payment expressed as a percentage of the stock price. So a 2% dividend yield means for every $100 you have invested, the company will hand you $2 in cash every year. This is a powerful signal. A company that pays a dividend is usually a mature, stable, profitable business. It's like a fruit tree that's so healthy it produces more fruit than it needs, so it shares some with you. High-growth companies, the racehorses with high PE ratios, almost never pay dividends. They need every penny of profit to reinvest in growing bigger, faster. So the dividend yield is a signal that tells you about the company's personality. Is it a young, hungry company focused only on growth? Or is it a steady, established giant that will pay you just for holding its stock? So let's recap our translator. We ignore the daily up and down. That's noise. We focus on the big signals. For our overall portfolio, total return tells us the real score. Allocation shows us our risk. Cost basis is our anchor to reality. For individual stocks, P/E ratio is the price tag telling us if we're buying growth or value. Dividend yield tells us if we'll get paid to wait. By focusing on these 5 signals, you transform yourself. You are no longer gambling. You are no longer reacting to the noise and chaos of the market's emergency room. You are the calm, collected doctor, confidently reading the vital signs, understanding the true health of your patient, your money, and making informed, intelligent decisions. You're finally reading the story your portfolio has been trying to tell you all along. But now that we can read the dashboard, how do we actually decide where to go? How do we find those promising companies in the first place and separate the future winners from the duds destined to fail? That's where the real strategy begins. It's time to build our GPS, our navigation system for the market. It's time to build your first watch list. A watch list is not a wish list. It's a battle plan. It's the single most important tool that separates disciplined investors from gamblers. A gambler opens their app, sees what's flashing green, and throws money at it, hoping for the best. An investor opens their app, looks at a pre-approved, pre-vetted list of companies they've already decided are high quality, and waits for the right opportunity. The watch list is your filter. It's the velvet rope that keeps the thousands of bad ideas and speculative garbage stocks out, and lets only the worthy contenders into your exclusive club. Think of it like this. You wouldn't walk into a car dealership and say, "Give me whatever car is most popular today." You do your research first. You decide you want a safe SUV with good gas mileage that fits your family. You narrow it down to a few models, a Honda, a Toyota, a Ford. Then you go to the dealership, armed with knowledge, ready to negotiate. Your watch list is that list of pre-approved models. The stock market is the dealership. Without the list, you're just a tourist waiting to be taken for a ride. So, how do we build this thing? Where do these initial ideas even come from? It starts with a principle made famous by one of the greatest investors of all time, Peter Lynch. He said, "Invest in what you know." This is the most intuitive and powerful starting point in the entire world of finance. Right now, just look around you. I mean it. Pause and look. What brand of phone are you holding? Apple? Samsung? What brand of computer is on your desk? Dell? Microsoft? What did you have for breakfast? Starbucks coffee? A Kellogg's cereal? Do you see where I'm going with this? You are surrounded by publicly traded companies. You are an expert in your own consumption habits. You already have deep first-hand knowledge of dozens of businesses. You know which products are great and which are terrible. You know which companies have fanatical customer loyalty and which ones make you want to pull your hair out. This is market research that Wall Street analysts would kill for, and you're doing it every single day for free. So let's make it official. Open your stock market app right now. Find the watch list or lists feature. Create a new list and call it Companies I Use. Now start populating it. Think about the stores you shop at. Target, Costco, Home Depot. Add them. Think about the products you can't live without. The toothpaste you buy, the soda you drink, the streaming service you binge watch. Procter & Gamble, Coca-Cola, Netflix. Type in the company name or its ticker symbol. That's the 1 to 5 letter code for the stock. And hit Add to Watch List. Don't judge. Don't analyze. We are not buying anything. We are simply building our universe of ideas. The goal here is to fill this first watch list with 10 to 15 companies whose products or services you understand intimately because you are the customer. This is your home turf. You have an advantage here. Okay, that's bucket number 1. The world you know. But what about the world that's coming? This leads us to our second source for ideas. Megatrends. These are the powerful, transformative forces that are changing the very fabric of our society over the next decade. Think about the shift from gasoline cars to electric vehicles. That's a megatrend. Think about the rise of artificial intelligence, the revolution in clean energy, the aging of the global population, which creates massive demand for new healthcare solutions. Investing in a megatrend is like setting your sail in a powerful, consistent wind. You don't have to be a perfect sailor to move forward. The trend itself provides the momentum. Your job is to find the best-built ships in that fleet. So how do you do that? You start with a simple search, not in your stock app, but in your web browser. Type in companies in the electric vehicle charging space, or top cybersecurity stocks, or leaders in gene editing technology. You'll find articles and reports listing the key players. You'll see names like Tesla and Rivian in the EV space, but you'll also see companies that make the batteries, the charging stations, and the software that runs it all. Now here's the critical step. You take those names back to your stock app. Create a new watch list. Call it Future Trends. Add the most compelling companies you found to this list. Again, we are not buying. We are not even researching yet. We are simply collecting candidates. We are scouting the field. Maybe you're passionate about renewable energy, so you add a couple of the biggest solar and wind power companies to your list. Maybe you believe AI is the future. You add NVIDIA, the company making the chips that power the revolution, and maybe a few smaller, more focused AI software companies. By creating these separate watch lists, Companies I Use and Future Trends, you're organizing your thoughts. You're building a framework for your future investment decisions. Now for our third and final source of ideas, and this one comes with a huge warning label. We can learn from the masters. Institutional investors and massive hedge funds managing billions of dollars are required by law to disclose their stock holdings every quarter in a filing called a 13F. There are websites that make it easy to track these filings. You can literally look up what Warren Buffett's Berkshire Hathaway or other legendary investors owned at the end of the last quarter. This can be a fantastic way to discover high-quality companies you've never heard of. You might see a name pop up in the portfolios of 3 or 4 brilliant investors and think, I should probably figure out what that company does. So here's the action. Look up the holdings of an investor you admire. Find a company in their top 10 holdings that you don't recognize. Go to your app, create a third watch list called Research Projects, and add that one company to it. But now for that warning label, and please listen closely. You should never, ever buy a stock just because a famous investor owns it. That is a guaranteed recipe for disaster. Why? First, the 13F filing is old news. It shows what they owned up to 45 days after the quarter ended. You could be looking at a position they've already sold. Second, you don't know why they bought it. It might have been part of a complex strategy involving other assets. Third, and most importantly, you have no idea what price they paid. Buying a great company at a terrible price is a bad investment. They might have gotten in at $50 a share, and you're looking at it now at $200. So, we use these filings for one thing and one thing only: idea generation. It's a way to find potential companies to add to our research projects watch list, nothing more. Okay, stop. Look at what you've done. You now have 3 distinct lists populated with potential investments. You have companies you understand as a customer, companies riding massive societal trends, and companies vetted by the world's best investors. You have officially moved from a reactive gambler to a proactive strategist. You've built your command center. So what happens now? The watch list has a secret superpower. It's not just a list, it's an automated sentry. For every single stock on your new lists, you can set a price alert. Let's say you love Costco. You shop there every week. You added it to your company's I use list. You pull it up in your app and see it's trading for, say, $850 a share. You think, wow, that's a great company, but that feels a little expensive for me right now. Instead of walking away or worse, impulsively buying it out of fear of missing out, you deploy the superpower. You set a price alert. You tell your app, notify me if Costco's stock price drops to $750. And then you walk away. You go about your life. The app is now doing the work for you. It's watching the market 24/7. If and when the market has a bad day or a bad week, and the stock you already decided you like goes on sale, your phone will buzz. It will give you a tap on the shoulder and say, hey, that opportunity you were waiting for? It's here. This one simple feature completely flips the psychological script of investing. It turns you from a frantic chaser of rising prices into a patient hunter, calmly waiting for the price to come to you. It enforces discipline. Building the watch list separates the emotional, ooh, that's an interesting company, from the logical, is this a good investment right now? Setting the price alert automates your patience. Your watch list is now your personal, curated menu of investment opportunities. But a menu is just a list of options. You still have to decide what's actually good for you. How do you look at a company on your list, a company like Nike or Nvidia, or that one you found in Warren Buffett's portfolio, and actually figure out if it's a strong, healthy business worth your hard-earned money? How do you separate the truly great businesses from the hype machines that just look good on the surface? That requires a new set of tools. It's time to learn how to look under the hood. It's time to learn the language of business, the language of numbers. And that language is found in 3 core documents, the 3 pillars of financial analysis: the income statement, the balance sheet, and the statement of cash flows. Now I know what you're thinking. Financial statements? I'm out. This sounds like homework. But stick with me because I'm going to make this incredibly simple. Think of it like this. The income statement is the company's report card for the year. The balance sheet is a snapshot of its overall health, like a doctor's checkup. And the cash flow statement is like looking at its bank account to see where the money is actually coming from and going. Every major stock market app has a section for this, usually labeled financials or statistics. You don't need an accounting degree, you just need to know what to look for. Let's start with the report card. The income statement. This document tells you a story over a period of time, usually a quarter or a year. It answers one simple question. Did the company make money? The 2 most important lines you need to find are at the very top and the very bottom. At the top you have revenue, also called sales. This is the total amount of money the company brought in. Is that number going up year after year? If a company isn't selling more of its stuff over time, that's a potential red flag. Think of a restaurant. If it's selling fewer and fewer meals each year, you'd be worried about its future, right? Same principle. Now scroll all the way to the bottom. You'll find the most famous line in all of business. Net income. This is the profit, the bottom line. After paying for all the ingredients, the employees, the rent, the taxes, everything, is there any money left over? You want to see a company that is not just profitable but increasingly profitable. A company that consistently grows its revenue and its net income is a company that knows how to run its business. Right next to net income, you'll often see something called EPS, which stands for earnings per share. Don't let the acronym scare you. It's just the net income divided by the number of company shares. It's a way to standardize the profit to see how much profit is being generated for each individual share you might own. A steadily rising EPS is one of the most beautiful sights for an investor. So the report card looks good. The company is getting A's. But is it healthy? That's where we turn to the second document, the balance sheet. Unlike the income statement that covers a period of time, the balance sheet is a snapshot. It's a picture taken at a single moment saying, here's what we own and here's what we owe right now. What it owns are its assets, cash, inventory, factories, equipment. What it owes are its liabilities, bank loans, bills to suppliers, debt. The simple formula is assets minus liabilities equals equity. Equity is the good stuff. It's the value that belongs to the owners, the shareholders. You want to see a company whose assets are growing. But more importantly, you need to look at its debt. In your app, look for a ratio called the debt-to-equity ratio. This is critical. It compares the company's total debt to the shareholders' equity. Think about it in personal terms. If you have a $100,000 net worth but you owe $500,000 in credit card debt and loans, you're in a very dangerous position. The same is true for a company. A company with a mountain of debt is fragile. A small economic downturn, a hiccup in their business, and they could find themselves unable to pay their bills, spiraling towards bankruptcy. There's no magic number. But you want to compare a company's debt-to-equity ratio to its competitors in the same industry. A tech company might have very little debt, while a utility company that builds massive power plants might have a lot. Context is key. The other health check on the balance sheet is the current ratio. This compares a company's current assets, stuff it can turn into cash within a year, to its current liabilities, bills it has to pay within a year. A ratio above 1 means it has more short-term assets than short-term bills. It can pay its rent this month. A ratio below 1 could be a warning sign that the company is living paycheck to paycheck. So, the company has a great report card and a clean bill of health. But there's one last crucial test. And it might be the most important of all. The cash flow statement. A famous saying in accounting goes, revenue is vanity, profit is sanity, but cash is reality. A company can use all sorts of accounting tricks to make its revenue and profit look good on the income statement. But they can't fake the cash in their bank account. The cash flow statement shows you the real deal, hard cash moving in and out of the company. It's divided into 3 sections, but we only need to focus on one. Cash flow from operations. This number tells you if the company's core business is actually generating cash. Is its day-to-day work of selling widgets or providing services bringing in more cash than it's spending? This number should be positive and, ideally, growing. If a company claims to be highly profitable on its income statement, but has negative cash flow from operations, sirens should be going off in your head. It's a massive red flag. It means the business itself is a cash-burning machine, and it's relying on loans or other financing just to stay alive. You want to invest in businesses that gush cash from their operations, not ones that bleed it. Okay, deep breath. We've looked at the 3 core statements. Now, how do we tie it all together to decide if a stock is a good buy? We use a few key ratios that your app will calculate for you. The most famous is the PE ratio, or price-to-earnings ratio. This takes the stock's current price and divides it by its earnings per share, that EPS we talked about. It basically asks, how much are investors willing to pay for $1 of this company's profit? A high PE ratio, say 50, means investors are paying $50 for every $1 of current earnings. This usually means they expect massive growth in the future. A low PE, say 10, means the market is less optimistic. It could be a sign that the company is a bargain, an undervalued gem. Or it could be a sign that the company is in trouble, and investors are staying away. A PE ratio is useless in a vacuum. You have to compare it to the company's own historical PE and to other companies in the same industry. Is its PE higher or lower than its direct competitors? Why? Answering that question is the beginning of true investment analysis. Another great one is return on equity, or ROE. This measures how effectively the company's management is using the shareholders' money, the equity, to generate profits. A company with a consistently high ROE, say above 15%, is often a sign of a high-quality business with a strong competitive advantage. It's a wealth compounding machine. You see the shift? We've gone from gambling on a squiggly line to being a detective. We're looking for clues. Does the company have growing sales and profits? Is its debt manageable? Is its core business a cash-generating machine? Is it valued reasonably compared to its peers? You don't have to be a Wall Street analyst to do this. All of this information, the revenue, the net income, the debt to equity, the PE ratio, the ROE, is sitting right there in your stock market app, under the Financials or Statistics tab. It's waiting for you. By spending just 10 minutes looking under the hood, you can avoid so many landmines. You can start to separate the durable, world-class businesses from the flavor-of-the-month story stocks that are destined to crash and burn. You're no longer just buying a ticker symbol. You're becoming a part owner in a business you understand and believe in. But even if you find the perfect company, a cash-gushing, low-debt, high-growth machine, there's still one massive, catastrophic mistake that almost every new investor makes. A mistake that can wipe you out no matter how good your research is. Buying the best company in the world is pointless if you make this one foundational error. You have to build a fortress around your investments. You have to protect yourself from the one thing you can't predict, the future. And that fortress isn't built with a single stock. It's not built by finding the next Tesla or the next Amazon. In fact, relying on that is like building a castle on a single rickety pillar. The real fortress, the one that withstands the hurricanes of the market, is built on a simple, ancient principle that has protected wealth for centuries. It's called diversification. Now I know what you're thinking. Don't put all your eggs in one basket. We've all heard it. Sounds boring. Sounds like something your grandpa would say. But it is, without a doubt, the closest thing to a free lunch in investing. Most people hear diversification and think it means buying shares in both Coca-Cola and Pepsi, or maybe buying Ford, GM, and Tesla. And while that's a start, it's like fortifying your castle by adding a few extra stones to the front gate, while leaving the back wall wide open. True, powerful diversification is about building defenses on multiple fronts, across entirely different battlefields. Let's break down the 3 critical layers of this fortress. The first layer is diversifying across companies and industries. This is the one most people get. If all your money is in tech stocks, and a new regulation hits the tech industry, your entire portfolio takes a nosedive. But if you also own shares in healthcare and consumer staples, the companies that sell toothpaste and toilet paper, and in industrial companies, a storm in one sector becomes just a little bit of rain on your overall parade. A problem for Apple doesn't affect Johnson & Johnson. A bad quarter for a bank doesn't stop people from buying groceries at Kroger. By spreading your investments across different sectors of the economy, you insulate yourself from the unique risks of any single industry. You're not betting on one horse to win the race. You're betting on the race itself. But here's where most retail investors stop. And it's why their fortresses crumble during a real crisis. The second and far more important layer is diversifying across asset classes. This is the big one. This means not just owning stocks. An asset class is just a category of investments that behave in similar ways. Stocks are one asset class. Bonds are another. Real estate is another. Commodities like gold are another. Why is this so critical? Because these different asset classes often move in opposite directions. Think back to the dot-com bust or the 2008 financial crisis. The stock market was in absolute freefall. People who only owned stocks saw their portfolios get cut in half or worse. But during those same periods, government bonds, which are essentially loans to the government, held their value or even went up. They acted as a shock absorber. When fear grips the stock market, money floods into the perceived safety of bonds. Having a portion of your money in bonds is like having a powerful counterweight. When stocks go down, the bond side of your portfolio helps cushion the blow, preventing catastrophic losses and, more importantly, preventing you from panic selling at the absolute worst possible time. The third layer, which is often overlooked by Americans, is diversifying geographically. We tend to have a home country bias, putting all our money into U.S. companies. And for the last decade, that's been a winning strategy. The S&P 500 has crushed most international markets. But history tells us this isn't always the case. There have been entire decades where international stocks outperformed US stocks. By investing a portion of your money in developed international markets like Europe and Japan, and even a small slice in emerging markets, you protect yourself from the risk of a single country's economy stagnating. You're building a global fortress, not just a local one. So you have the blueprint. Diversify across industries, asset classes, and geography. But how do you actually build this thing? This brings us to the most practical decision you'll ever make as an investor: your asset allocation. This is simply the percentage of your money you put into each of those buckets, specifically stocks versus bonds. This isn't a one-size-fits-all answer. It depends entirely on your age, your financial goals, and your stomach for risk. A 25-year-old with a stable job who won't need the money for 40 years can afford to take on a lot of risk. They can go heavy on stocks, maybe 90% stocks and 10% bonds, because they have decades to recover from any market crash. In fact, for them, a crash is a good thing. It's a fire sale, a chance to buy more shares at a discount. But a 65-year-old on the verge of retirement has a completely different priority. Their goal isn't massive growth. It's capital preservation. They can't afford to see their nest egg cut in half right before they need to start living on it. They might have an allocation closer to 50% stocks and 50% bonds, or even more conservative. A classic rule of thumb to get you started is the 110 minus your age rule. Subtract your age from 110, and that's the percentage you should consider putting in stocks. So if you're 30, you'd have 80% in stocks. If you're 60, you'd have 50% in stocks. It's a simple guideline, but it beautifully illustrates the core principle. Your portfolio should become more conservative as you get older. Now you might be thinking, this sounds complicated. Do I have to go buy hundreds of different stocks and bonds? Absolutely not. This is where your stock market app becomes your greatest ally. The invention of the exchange-traded fund, or ETF, makes building this fortress incredibly easy. An ETF is a single fund that you can buy and sell just like a stock, but it holds hundreds or even thousands of different underlying investments. Instead of trying to pick the best US stocks, you can buy a single ETF like VTI, the Vanguard Total Stock Market ETF. With one click, you own a tiny piece of over 3,000 American companies. You've instantly diversified across every industry in the US. To diversify internationally, you could buy an ETF like VXUS, which holds thousands of stocks from outside the US. And for your bond allocation, you could buy an ETF like BND, the Vanguard Total Bond Market ETF, which holds a mix of thousands of US government and corporate bonds. With just 3 ETFs, you can create a globally diversified, multi-asset class portfolio in about 5 minutes. It's the ultimate shortcut to building a robust financial fortress. But building the fortress is only half the battle. You also have to maintain it. This leads to the final, and perhaps most powerful secret weapon of the disciplined investor: rebalancing. Let's say you decide on a 70% stock, 30% bond allocation. Over the next year, the stock market has a fantastic run and your stocks go way up in value, while your bonds stay relatively flat. At the end of the year, you look at your portfolio and realize that because of that growth, you're now at 80% stocks and 20% bonds. You have drifted away from your plan. Your portfolio is now riskier than you intended it to be. Rebalancing is the simple act of selling some assets and buying others to get back to your original target. In this case, you would sell some of your stocks, the ones that have performed so well, and use that money to buy more bonds until you're back at your 70-30 split. This might feel counterintuitive. Why would you sell your winners? But look at what you're systematically forcing yourself to do. You are automatically selling high and buying low. You're taking profits from an asset that has become expensive and reinvesting them into an asset that is now, by comparison, cheap. It is a disciplined, unemotional mechanism for harvesting gains and managing risk. It prevents you from getting too greedy when the market is hot, and it forces you to buy when others are fearful and assets are on sale. This simple periodic tune-up, maybe once a year, keeps your fortress strong and aligned with your goals. This entire framework, diversification, asset allocation, and rebalancing, is the foundation of safe and effective investing. It's not about predicting the future. It's about building a structure so robust that you don't have to predict the future. It's a system designed to protect you from the world, and more importantly, to protect you from yourself. It's the difference between gambling and investing. And once you have this fortress built, you're ready for the final piece of the puzzle: The one thing that truly separates the amateur from the professional and determines whether you will build modest wealth or life-changing wealth over the long run. It's not a secret algorithm. It's not a hot stock tip whispered in a back room. And it's not some complex trading strategy reserved for Wall Street elites. The single most important factor for your long-term success is something you already have complete control over. It's your own mind. It's mastering the psychology of investing. Because here's the brutal truth. You are your own worst enemy. The stock market app in your pocket is not just a tool for buying and selling assets. It's a direct pipeline to the two most destructive forces in finance: fear and greed. Every single day, that little icon on your phone will tempt you, it will scare you, and it will try to convince you to abandon the very plan we've spent all this time building. Think about it. When the market is soaring, the app glows a beautiful, seductive green. Every news headline is positive. Your friends are bragging about their gains. This is when greed whispers in your ear. It says, go all in. Mortgage the house. This is it. You can't lose. It fuels a dangerous feeling of FOMO, the fear of missing out, pushing you to take on reckless risks, buying high simply because everyone else is. And then comes the crash. It always does. The app turns a terrifying blood red. The numbers are plummeting. The news channels are screaming about a recession. Your portfolio, which looked invincible just weeks ago, has lost 10, 20, maybe 30%. This is when fear kicks down the door. It screams, sell. Sell everything before it goes to zero. Get out now. Save what's left. It triggers a primal panic response, compelling you to sell low, locking in your losses and guaranteeing you miss the eventual recovery. This emotional roller coaster is the single greatest destroyer of wealth for the average person. It's a game rigged against your own human nature. But you can win. You win by understanding the game and refusing to play. Let me tell you a story about two investors. We'll call them Alex and Ben. Both are smart, both have good jobs, and both start investing with $10,000 using the exact same app. They both invest in the same simple, diversified S&P 500 index fund. For the first year, the market goes up 20%. Alex is ecstatic. He checks his app 10 times a day, watching the green numbers climb. Greed takes over. He sees other stocks, tech stocks, meme stocks, that are going up even faster. He thinks, the S&P 500 is for chumps. I can do better. He sells his safe index fund and starts day trading, chasing hype, trying to time the market perfectly. Ben sees the same 20% gain. He thinks, great, the plan is working. He doesn't change a thing. He has his automatic contributions set up and he just keeps buying month in and month out. He barely even opens the app. The next year, the market crashes by 30%. Alex is in a panic. The high-flying stocks he bought have been decimated, down 50, 60, even 70%. Fear consumes him. He sells everything near the bottom, vowing never to trust the stock market again. He's lost most of his initial investment. What does Ben do? Nothing. His automatic contributions continue. When the market is down 30%, his regular monthly investment is now buying shares at a massive discount. He doesn't see it as a loss. He sees it as a sale. He's buying the same great American companies he was a year ago, but now they're 30% off. He's not timing the market. He is simply giving his money more time in the market. Fast forward 10 years. Alex is still sitting on the sidelines, his money in a savings account getting eaten away by inflation. He tells everyone how the market is a rigged casino. Ben, on the other hand, never sold. He weathered the storm. The market recovered, as it always has historically, and went on to new all-time highs. His initial $10,000, plus his steady automated contributions, has grown into a life-changing sum. He didn't do it by being a genius. He did it by being disciplined. He won by doing nothing. This is the most powerful and most counterintuitive lesson in all of investing. Your app will tempt you to do something. The financial news industry, which profits from clicks and views, is designed to make you feel like you need to react to every headline. But the greatest investors in history, from Warren Buffett to Jack Bogle, all preach the same gospel. The most profitable moves are the ones you don't make. So how do you actually achieve this state of Zen-like discipline? You use the app to defeat the app. You automate your own success to protect you from your own worst instincts. First, you set up automatic transfers from your bank account to your brokerage account every single payday. Don't give yourself the chance to spend it. Pay your future self first. Second, you set up automatic investments. That money shouldn't just sit in the brokerage account as cash. It should be automatically invested into your predetermined, diversified portfolio of index funds or ETFs. This is dollar cost averaging on autopilot. You will automatically buy more shares when prices are low and fewer shares when prices are high. You are systematically, without any emotion, executing the perfect strategy: buy low, buy high, buy consistently. Once this system is set up, your job is to get out of the way. Delete the app from your phone's home screen. Tuck it away in a folder you never open. Turn off all notifications. The urge to check it constantly is a trap. It provides no useful information for a long-term investor. The day-to-day movements of the market are meaningless noise. They are a distraction designed to make you panic. Your goal is to go from checking your portfolio daily to weekly to monthly and eventually to only checking in once or twice a year to make sure your plan is still on track. The app should be a tool you use with intention, not a slot machine you pull for a dopamine hit. And this brings us to the final and most important anchor that will hold you steady through the inevitable storms. It's the reason you'll be able to ignore the noise and stick to the plan when everyone else is panicking. You need to define your why. Why are you even doing this? Seriously, take out a piece of paper and write it down. Is it to retire at 60 with dignity and freedom? Is it to pay for your children's college education so they can start life without debt? Is it to buy a house? Is it to have FU money so you're never trapped in a job you hate? Get specific. Get emotional. Your why cannot be, "I want to get rich." That's not a reason, it's a wish. A real why is a picture of the life you want to build. When the market is crashing and that red number on the screen makes your stomach churn, you won't be thinking about the S&P 500. You'll be thinking about that future. You'll be thinking about your kids walking across the graduation stage. You'll be picturing yourself on a beach, financially secure, not worrying about bills. That is what keeps you from hitting the sell button. Your why is the bedrock of your psychological fortress. So let's bring it all together. Over this journey, we've learned that using a stock market app safely and effectively has almost nothing to do with picking hot stocks. It's about building a system. It's about choosing a reputable, secure platform. It's about building a diversified, low-cost portfolio that matches your goals. It's about fortifying your accounts against hackers and scammers. And most importantly, it's about building a fortress around your own mind. It's about understanding that the app is just a tool, but your emotions are the real battlefield. You win by creating a simple, automated plan and then having the discipline and the courage to let that plan work for you over decades. You win by remembering your why. When the world is telling you to be afraid, the power to build incredible, life-altering wealth is literally in the palm of your hand. But the key to unlocking it isn't in the app. It's in you.